Welcome to the Me and Money podcast, where your hosts and certified financial planners, Matt Fizell and Elliott Appel, share their thoughts on hot topics, important concepts, and real-life stories in personal finance. Hear from Matt and Elliott as they share lessons learned in their own financial journeys and those they've witnessed throughout their careers while helping clients. Have a question you'd like to hear discussed on a future episode of the podcast? You can reach out to Matt or Elliott or drop your question at the link listed in the show notes. Before we get to the episode, we'd like to remind you that while both Matt and Elliott are financial planners, they are not your financial planner, and this podcast is only intended for educational purposes. For full disclosures, please be sure to listen to the end of the episode or check out the show notes on your favorite podcast platform. Now, on to the show with your hosts, Matt Fizell and Elliott Appel.
Welcome back to another episode of the Me and Money podcast. We got a new episode and a new type of account to talk about today.
Just what we need more of, right? More complexity in the financial and tax planning world.
Yeah, and the best part is its legal name is the 530A, so not too far away from the 529. And they do have some similar function, but we're going to talk about those good old Trump accounts today. So if you're listening to this, you can't even open one of these darn things until July, and that's what they say, but who knows how long it'll take Schwab and the rest to actually get a form together to open this thing. But I think it's an interesting situation. I'm not ready to say I'm a fan of it, but Elliott, why don't you kick us off? Tell us a little bit more what the account is, and we'll go from there.
So I will preface this is a new account, as we alluded to. You can't even open one yet. So I think there's still a lot of things to be figured out that people aren't quite sure how these work. And this is going to be a longer episode. I think I could make this into a 30-second episode probably, but we'll keep it longer to explain what's actually going on here. So I think the biggest thing is any baby born between 2025 through the end of 2028 gets a free $1,000 from the government, assuming you open this account, you claim it. It's not an automatic thing like a child tax credit or anything like that goes on your tax returns. You actually have to take some proactive steps to get this free $1,000 that you put into this Trump account that's held somewhere and has some sort of investments and selection of what you can do with it. So that's the key. And then you can put up to $5,000 per year into this account, whether that's you directly contributing. There's also been talk about how employers can make contributions. I haven't read a ton about these accounts, so I'm not aware of any employer has come out and said, yes, we're definitely going to do this and contribute to that. But I imagine it's like any other type of retirement account out there that the longer it's around, if people adopt it and use it, maybe you see more of that at some point in the future. And I know, Matt, that's where he said maybe this gets more interesting. And I just keep making the joke, yes, this is useful when you get free money. Beyond that, I don't know about the use of the account. We'll talk about that a little later in the episode. What else would you add about this account?
Yeah, I think it's going to be really interesting. And maybe just for me, like working with more business owners, like if you can make some contributions to your own child's, Trump account, and you can take a straight up business deduction for that. Like these are people who are usually in the 24 and above tax bracket. So it could be pretty powerful, like tax savings there for them, but there are some catches that come with it. I'm with you. I think the jury's way, way, way out on this one at this point, like not even close to really how I feel about it, but the free $1,000 is awesome. Having more options isn't necessarily a bad thing, but I really do think this is going to hinge on how employers handle it, because it's kind of a mess from a tax perspective. I know before we started this episode, I think there's some really interesting scenarios that we could play out as to how this is going to work. But at the same time, like for the kids getting this $1,000, like God only knows what the tax code's going to be by the time they're 18. And who knows?
Well, the complexity with this, just to dive into the taxes a little bit detailed, because we haven't talked about that, is my understanding is those employer contributions and or the government's $1,000, those are going in pre-tax. Mm-hmm. Any contribution you make personally is going in after tax. So similar to an IRA, ultimately you could end up with some pre-tax and some after-tax dollars that when you can actually take money out of this in the future, 59.5 later on without penalty, you're going to have some split, a pro rata rule of some of the distribution you're taking is taxable, some of it is not, assuming you don't do any Roth conversions or anything like that sooner. And in my mind, I don't love taking a lot of after-tax dollars if we're talking about personal contributions and then putting them into an account that is then going to turn into ordinary income, which gets to the point of the consensus in the planning community, I would say, is why are we taking these after-tax dollars, putting them into an account to turn them into ordinary income when we can make a contribution to a brokerage account and get capital gains treatment, which tends to be better. Yes, there is some, we'll call it tax drag on the account throughout time, but there's ways to make that more efficient. But oftentimes that capital gains treatment is better than that ordinary income treatment later on. So I think a lot of people are sort of looking around like, why would we do this other than the free money?
I think it would be a very different conversation if like the parent could get a tax deferral or just a straight up tax deduction, because they wouldn't be realizing that tax in the future. Their kid would, but that seems like too good of a deal. And I don't think the government wants to give us that good of a deal. So I'm with you there. And that's kind of why I come back to, I think this is largely going to hinge on how many employers adopt this and what that actually looks like. I think that's where a lot of the power in the strategy would be, but otherwise I'm pretty meh on this one.
Yeah, because there are a lot of other options out there, right? We were talking before the episode. You have your 529 plan, which could be used tax-free for qualified educational expenses. You have just a plain brokerage account, whether that's you as a parent personally investing that and then gifting that later on, and or putting that in an UTMA account for your kid. Both of those provide a lot of, between the two, sort of ultimate flexibility for education, starting a business, all of that, that I would argue probably have better tax treatment than this eventually. And they're more flexible and you can get to the funds sooner than these accounts. These accounts really are meant for retirement. Yes.
Yeah. Well, that, or they can just be used along the way, right? So, there are some different distribution rules as opposed to an IRA, right? They do function a lot like a traditional IRA. But even then, like, I don't know. I think one thing to think about, like, even from a 529 comparison perspective, if you do use it for education, like, duh, it's a no-brainer to go the 529 route. I'm really shocked, like, there isn't some type of a provision to allow for some type of a Roth conversion, because the 529 does have that feature now. And I think that's more beneficial, like, essentially a tax-free Roth conversion. Obviously the limit's not quite as high on these accounts for a contribution. So are you really going to have that much in there on average? Probably not. But then too, right? If you do take those funds out of a 529, you're still going to pay a penalty on it if it's not for a qualified use, right?
But even that's not that bad. We're talking 10% on.
Well, yeah, but I think that's where I, kind of before we got on the call today, like if an 18-year-old who's probably not making much, if any, money at all, starts to take withdrawals from this account, are they really going to be paying more than 10% effective rate on that income?
Depends on if they're being claimed as a dependent or not. That's the big thing in kiddie tax rules coming.
But that's where I think there is a more nuanced conversation here, because like I look at my situation, I was providing most of my support when I was in college. So for me, like, I could take quite a bit of money from this account, just claim the standard deduction and maybe still have to pay some taxes after that. But is it going to be effectively more than 10%? I guess it depends how fast you take the money out of the account and how much it's actually grown since then, right? But yeah, I think the UGMA account probably, if I were starting an account for a child like today, like, yeah, I'd take the $1,000 for free, never contribute to that account again, and probably go the UGMA route, because, with that, you have that $2,700 of wiggle room on dividends and things like that before you'd ever pay tax on it along the way. So it's essentially being tax deferred, just like the Trump account would. And then you're paying capital gains probably at zero, as you made note, when they turn 18. So I don't know. I think it's going to be interesting to see how this all plays out. But
Yeah.
generally, I
think
would agree with your
I think
your
like
analysis.
anything, there are some fringe cases where this could make sense. I think for the overwhelming majority of people, it's probably not. Again, other than the free money, probably not going to make a lot of sense for most people unless you find your very specific scenario. And maybe as it gets developed, and I mean, rules could be clarified or defined better, I think at some point, maybe at that point, something becomes more beneficial. But it really, like, it feels like overwhelmingly, this isn't, other than the free money, not going to benefit a ton of people.
Yeah, and that's the thing, right? Like, I mean, even look at 529 plans. Like, they would honestly fall into a very similar bucket for me up until the Roth conversion was an allowed feature of those accounts. Like, I mean, sure, the state tax deduction is great, but for how many people, like, how much are you really paying in state income taxes every year? Like, and how certain are you that your child is going to go to school, right? Like,
sounds like we need an episode on 529 plans.
Well, but it's different now. I feel entirely different now that there's the Roth conversion, provision in there. Like, that to me makes a ton of sense. Like, now it's a no-brainer. But back then, I think it would be a bit more of a nuanced discussion. Not applicable anymore. I still love the UGMA though. Like, I'm a sucker for a good brokerage account, and like just letting the person have flexibility in how they want to use it. I think there's a lot of value there. Plus, the tax treatment in this case is probably going to be better for most people when it comes to that versus a Trump account.
Yeah.
Yeah. The other issue that we kind of talked about is we don't really know how this may get treated for financial aid, right? Because the account will be in the name of the child, right? When they turn 18. And I don't know if there has been much guidance or clarity as to how that's going to show up on, your expected family contribution for college. And if that asset is being treated as theirs, or if they're just going to exclude it and say, no, like, this is kind of a provision of this account. I think that'd be interesting too, because a brokerage account, when you turn 18 for sure, will show up on your asset sheet.
Yeah. And it feels like one of those things where unless you have a ton of money in this, in which case you're not expecting any financial aid, in which case it's not a problem. But if you're, sort of the middle, and I feel like the middle has been sort of picked on with college, there are a lot of options. You either have to earn not so much and have very little in assets, or have a ton to be able to afford college. I feel like for those families in the middle, if they make these contributions, they're sort of putting their child in that situation where it sort of feels worse, right? They're not falling in either camp where they're getting aid. Now, college may look totally different in 18 years, but that's what came to mind as you were talking about that, is you end up with, I don't know, $30,000, $40,000 in this account. It's not really enough to pay for college, but it's probably enough to potentially make your financial aid package a lot worse.
Yeah. And then at that point, right, if it does, I think the strategy would be, well, get as much of it out of there as you can when you're 18 to pay for your education, and then hopefully get financial aid the next year, right? Like, I don't know,
yeah.
Right?
I mean, I don't know how you get it out at that point to pay for that sort of thing.
Well, you could just take a distribution, right? If you're 18 and you're past the threshold, like, presumably, right?
Yeah.
It is just one of those fascinating things where, I mean, I would love to go back and see, like, what people's opinions were on a Roth IRA, like, when it was first created. Like, I think a lot of it has evolved. Like, people weren't doing Roth conversions way back then. You know what I mean? Like,
well, it wasn't allowed for the longest time either.
Right, exactly. But that's, like, again, it's a new feature that has been added to and completely changed the perception of those accounts. And I can't think of an account that's been made since I started my career. Like, maybe, when did solo 401ks even come around?
I don't know.
Like, I don't know. Like, to me, this is kind of like the first new account that we've ever gotten, like, in our career. But certainly things have changed. Like, the 529 has really gotten revamped for a lot of those things, and even being allowed to pay for different things, right? Like, continuing education and credentialing and things like that. So it's become a lot more powerful, and that aspect. And I would have to imagine, based on the fact that I view this account very much as a legacy stamp by the administration, like I could see them saying, we're going to add some new features to this because the reception is kind of mixed.
I guess that's a take I hadn't considered, is expanded eligibility for different things, I guess we'll call it. Because I think it's one of those things that if we think back to like a Roth or a 529 plan, and I sort of have the opposite approach, is I've really loved 529 plans even without the Roth conversion, because I think there's a lot of flexibility for school or multi-generational planning for people. Like all those get me excited for different reasons. This one, I'm not, like, other than the free money, I'm not excited at all about it. So I think there'd have to be some sort of expanded eligibility on how it's treated. But I also have to wonder politically, when the next party comes in and you have something labeled a Trump account, like, is it just going to be a, hey, we're changing this because of the name? Like, I think you had, I know you roll your eyes, and for those listening, you're like, I think that's a consideration, right? We are talking about political parties who are not known for forgiving things or not holding grudges, for lack of better words, and being petty at times. So I also wonder if there's the other side of that, where as opposed to expanded eligibility, you're changing it entirely. I don't know. I'm speculating here, but
well, I'm just going to put it out there that the Roth is named after a senator. So, they didn't go and change that. I guess it does technically have, the 530A designation, but so too does every other account type. They, if anything, can they just rebrand the freaking simple IRA to the most complicated IRA possible? Like, man, I had to get that in there. That one just triggered me. But, yeah, it will be interesting. And I think too, like, I think my bigger concern would be like massive changes to the tax code. And like, is that when they start to change how some of the distributions for this type of a thing works? Like, maybe they make it an inferior account to the point where nobody wants one, like kind of where it already is. But yeah, it's really interesting to think about. But I never really thought about that this might be the first truly new account that we've seen in our working career. As Elliott, for those of you not watching, just furiously Googles away.
Which, of course, trying to find things on search engines these days. I was trying to see when different retirement accounts came to be, but I can't quickly find it.
The Roth was like the 80s, right?
I think it was later than that. 1997. Yeah, okay. I should know this because my former mentor had this as a trivia question in one of his presentations.
There you go. Yeah, way before my career. So it's just one of those useless things I never think about. But yeah, I think it'll be really interesting just to see, number one, like how the rollout goes. Number two, like, are there going to be any other government funded contributions or ways you can get free dollars into there? I still think the account will be way more popular if you could get a tax break in some way, shape, or form. Like,
sure,
maybe it's only $1,000 of it is tax deductible, but you got to give some people an incentive to do this versus an UGMA or a 529 plan, because they're way more. People are probably not very familiar with UGMA accounts, but everyone and their mother knows about the 529 plan, right? And I think it's interesting too, like your position on a 529 plan, even in a state with no state income tax, like,
yeah.
So tell me more about that.
Let's save that for another episode, because that could easily be a whole nother episode. And I want to keep this focused on Trump accounts, if you're okay. Or 530A accounts.
I don't think I have too much to add to this one. I think it's really going to be a wait and see. I think it is very situational. I do think there's some situations where you could be getting those pre-tax dollars from an employer and probably not paying tax on it, which is like, that's awesome. Like if it doesn't count to you and income and
free money
kid gets it tax free, like, but free compounded tax deferred money, Elliott. Sure. Like it's kind of like, I guess, the HSA or 529 equivalent, right? But yeah, I don't know. What are your wrap up thoughts on this?
wrap up, pay attention to what comes with this and any changes. Go collect your free money when you can and go from there.
You do have to check a box on the tax return, though, to get the $1,000. It's not an automatic thing. So if you had a baby in 2025 and you haven't filed yet, which you should have, make sure to check the box or amend your tax return.
Sounds good.
All right. I'll see you next time, Elliott.
Sounds good, Matt.
Thanks for listening to this episode of the Me and Money podcast. We hope you enjoyed the show. Have a question you'd like to suggest for a future episode? Drop Matt or Elliott a question at their email or use the linked form in the show notes. Like what you heard? It would be a tremendous help to us in our mission of having real conversations about personal finance by leaving us a review on your favorite podcast app. A few words can go a long way in connecting those looking for content like ours on their app of choice. You can also support the show by liking, sharing, and subscribing. Thanks again for listening, and be on the lookout for future episodes soon.
The Me and Money podcast is hosted and produced by Harmony Outsourcing Services LLC. Matt Fizell is an investment advisor representative of Harmony Wealth L.L.C. Elliott Appel is an investment advisor representative of Kindness Financial Planning LLC. However, the views and opinions expressed by Matt and Elliott in this podcast are not intended as individualized investment advice on behalf of Harmony or Kindness, or as tax, accounting, or legal advice. Although we gather information from sources that we deem to be reliable, we cannot guarantee the accuracy, timeliness, or completeness of any information prepared by any unaffiliated third party. When specific investments or types of investments are mentioned, such mention is not intended to be a recommendation or endorsement to buy or sell the specific investment. Harmony is a registered investment advisor authorized to do business in the states of Wisconsin and Texas and other jurisdictions where exempted. Kindness is a registered investment advisor authorized to do business in Wisconsin and Washington and in other jurisdictions where exempted. Registration as a registered investment advisor does not imply a certain level of skill or training. This website contains links to the Harmony and Kindness websites that provide general information about the advisory services offered by Harmony and Kindness. These links are provided as a convenience only. Harmony and Kindness can only provide individualized services after you sign an agreement and receive required disclosures. Users of this website may, but are not required to, engage the services of Harmony or Kindness for advisory services. Please remember that all investments involve varying degrees of risk, and the future performance of any specific investment or investment strategy is not guaranteed to be profitable or equal to any historical performances. As a final note, we'd encourage you to reach out to your financial professionals before implementing any of the strategies or concepts discussed in this podcast. Thanks again, and we'll see you next time.